when you look at this, what happens is if the policy performance goes down, if there's any stress on your ability to pay those premiums, these things can blow up in your face. So for wealthy people that are doing these premium finance cases, typically they're able to withstand several years in a row of the policy not performing well. Hey, what's going on, cash flow hackers? It's Chris with Life 180, and for this video, I'm gonna do something interesting. Behind me here, I've got a Kai-Zen illustration, which is ultimately one of the agents on my team sent this to me, and they were like, Chris, you gotta check this out. It's kind of crazy what's going on. I'm not sure if you've ever heard of premium finance, you as a listener watching this video, not what my agent said to me. But as you're watching this video, I'm not sure if you've ever heard of premium finance and what premium finance is. Ultimately, it's a strategy where wealthy people will use leverage or banks or loans to be able to fund a portion of an insurance premium, and they leverage arbitrage in that premium, i.e. the cost of the loans are cheaper than the growth of the policy. And they are able to utilize the combination of the two to create leverage, and it basically they can use less of their money, more of the bank's money to be able to accomplish a goal of accumulating more money and being able to have income on the back end of it. Now, there's been tons of class action lawsuits around these premium finance cases, and what I will say is that if you are, well, the people that do premium finance typically are people that are extremely liquid. They got a lot of money kind of sitting around, and they're able to just utilize that money to create leverage. Now, on the back end of this, and what I'm going to show in the disclaimers here as we go through this illustration is when you look at this, what happens is if the policy performance goes down, if there's any stress on your ability to pay those premiums, these things can blow up in your face. So for wealthy people that are doing these premium finance cases, typically they're able to withstand several years in a row of the policy not performing well. And in addition, they're typically, I would say, I shouldn't say they're typically, I guess I'll add in here that I'm a big believer that you shouldn't use this because this Kai-Zen program, I'm going to tell you it's an IUL product. I don't know what product they're using. This is just a marketing tool. I'm going to show it to you. But as we look at IUL in general, I don't think anybody that's over 50 to 55 years old at max should ever purchase an IUL. Well, I don't believe anybody ever should purchase an IUL unless there are very few underlying circumstances that would fall into that. I'm not going to get into that in this video, but what I will say is I don't think anybody should, but especially if you're 50 to 55, you're not giving the policy enough time to mature to be able to have enough cash value in there, get through all the expenses and the surrender charges and period and all that stuff before using it for income to make it worth your while. So that is that. Now, so what I'm going to do is I'm going to share my screen here, and what you can see, I'm going here. Let's see, am I on page one? No. Let's go back to page one. So page one here, you can see this is the title page of it. More protection for you and your family, Kai-Zen. Kai-Zen, I guess is how you say it. I'm going to be totally transparent. I'd never heard of this. One of my agents just sent this to me. I'm checking it out. We're going through this. So traditional retirement plans may be insufficient. You can see here, Kai-Zen's unique combination of financing and cash accumulation life insurance policy gives you more protection and the potential to accumulate more cash value. By using bank leverage, every dollar you contribute into the policy gives you the ability to use up to $3 additional to acquire more than you could without coverage. So one thing I want to point here is that this is all about life insurance coverage. Okay? So this is not, so what they're selling here is they're talking about this is going to give you more life insurance coverage. It's not talking about cash accumulation, so that's important to understand. Now, Kai-Zen protecting you and your family. Let's see here. Your cash accumulation policy is designed to maximize the cost of insurance while maximizing your potential tax-advantaged growth, cash value. The leveraged bank loan is projected to be paid off after the 15th year, asterisk, asterisk, asterisk. What does that mean? Let's go down here and see what asterisk, asterisk, asterisk means. Financing life insurance premiums has certain inherent risks, including interest rate fluctuations, financial market performance, credit availability, lender financial strength, lender funds available, insurance company ratings, and stability, which can result in bank exiting and or policy surrender. So this is saying, yeah, this is fantastic. It's going to create leverage for you. But the bottom line is what you're typically doing for a policy like this is you get into an IUL for more stability. If you think about why people are buying it, it's upside potential, downside protection. And by going in here and doing this sort of premium financing sort of arrangement, what's happening is you're increasing a ton of risk into a policy that you're buying for security, and it makes no sense. Most of the time, it is not in alignment with what the goals and objectives are for the person buying it. Once again, for wealthy people, this can make sense. For most people, this makes no sense at all. So let's go here. Depending on the policy performance. Okay, using the cash value of the policy through policy loans. Okay, so I was just finishing that statement. So just understand that that's a component to this thing, that there's a lot of risk when you do that. Now, cash accumulation features of the policy. So what you can see here is that they're explaining how the index works, that you have policy expenses right there, and then in the you have excess premium that goes into cash value. You're paying the cash value, gets put into a bucket with point-to-point S&P 500 index choice. They say index choice here, but they're saying the S&P 500. Ultimately, this isn't. They don't explain how this works really well. I'm going to get into. I'll explain because there's something later in the marketing piece here that will explain it. But ultimately, here's what they're doing. They're saying to maximize potential growth of your cash accumulation life insurance policy, you contribute $30,000 and the lender loans, $25,628 into your policy each year for the next 5 years. At the end of the 5th year, your contributions will end. However, the lender continues to pay premiums of $54,278 per year into your policy for years 6 through 10. With leverage, you get approximately 3 times more into your policy, which can potentially be used for supplemental retirement income. Potentially used for supplemental retirement income without having to make any loan guarantees, with no liability outside of the policy itself and the payments that you make into the plan. So what they're saying here is during these 5 years, that's you paying. The rest of this is leveraging a bank, right? And so it's important to understand. So they're gonna leverage the bank, some of it for the first 5 years. The last 5 years, the bank is gonna make all the premium payments. And you can see here, years 1 through 5, the bank is leveraging $25,628. You're leveraging 30, or you're putting in 30 for a total 150. And then year 6 through 10, the bank is gonna continue to pay $354. Your total leverage amount is just under 400 grand. You contribute a total of, between you and the bank, of $549,530. It sounds really good, but once again, the problems herein lies, well, here you got trust fees that are coming into this, so you're paying $1,350 a year for trusts. That's baked into those fees and expenses. But the problem comes when you're looking at the fact that these assumptions are just not realistic. So if you look right here, the growth rate assumption in this is 6.03. Now, these rates have been going down and down and down and down and down for a decade inside of IUL. So one of the big problems here is that I believe that this rate right here is going to be, like, I think you shouldn't be banking on anything more. I shouldn't do that. Anything more than, let's say, anywhere from 4 to 4.5% to be conservative, which, by the way, I believe you have no choice but to be over conservative, because the fact that you're going in here and you're utilizing this leverage, right, to create more and try to get this income, and you're doing this and you're not using your own money, you can't look at this as just upside with no downside, because there is a lot of downside, because at the end of the day, you're putting $150K of your own money into this policy, right? So if this leverage blows up on you, and I'm gonna show you something on, I think it's the next page or one of the next couple pages, you can actually lose all $150,000. Now, they like to tell you that this 6.03% is conservative. You know what? There was 5 years ago, they were saying 8.1% is conservative. The bottom line is 4 to 4.5% is really the number based on the cost of options and the performances of these policies. Now, this is the fine print that I want to get into. They say NIW uses conservative assumptions, provides annual servicing and monitoring with carriers and lenders until the loan is repaid. So they're saying they're going to be basically somebody that's going to help coach you and monitor this for you through it. So what happens after the bank is paid off? Once the lender is paid back, has been repaid, the assignment will be released. In the 15th year, the bank loan is projected to be paid off by using withdrawal and loans from the policy. Underperformance could delay this repayment. Once the bank loan has been repaid, you can take the distributions at any time dependent on the cash value. So there's a lot of things that come into this, right? There's the bank loan. There's the policy performance. Right, policy perf. So and then there's other components of this. So I'm gonna get back into this here. So will the caps on the index universal life policy change? Okay, so now what they say is the life carrier, this is where it gets totally deceptive in my opinion. The life carrier resets the cap on the IUL each policy anniversary and locks it in for the year. As interest rates rise or fall, the return of the insurer's general account changes, and this is passed on through the policy. As rates rise, the cap typically rises. As interest rates fall, the cap typically falls. The life carrier's profit is neutral on the cap. So that part is true. But the rest of it is totally half-truths. You have to understand how this works. What they're basically stating is that you have money. So let's just use this example. So what happens here, I'm going to go to the next page and I'm going to come back because I want to look at the numbers that they're dealing with. So you're putting in 30,000 bucks, you have $26,000 of accumulated value, right? Like actually no, you're using leverage. You got your 30,000, the bank's 25,000, bank loan amount that you're going to owe with interest is there, but the accumulated value is 47,891. Let's round that up. I'm going to round that up right now to 50,000 just for the sake of it, just because I want to deal with round numbers and I don't want to have to deal with a calculator. So let's say what happens here, you have to understand how this works. It's not so simple as the interest rates going up and interest rates going down. This, to me, this whole section that they're talking about here is a half-truth. And anytime a company like this is willing to put a marketing material out with a half-truth that makes it look like it's better than it really is, to me, I'm not going to trust them worth anything. So here's what really happens. You have 50,000 bucks. It goes to the general fund of whatever life insurance company that they're using. That general fund is going to get a return. Let's call it 4% because that's typically what the general funds in the life insurance companies are returning these days. So it goes into the general fund, 4% of $50,000. Let's just call it $2,000. This $2,000 is what's known as an options budget. Now here's what they're saying. This general fund, so this is what they're saying right now, is that the cap rate is based solely on the fixed market. That's what they're saying. It's based on the performance and interest rates, right? As interest rates go up, because life insurance companies use treasuries, bonds, fixed products, typically the general fund performance goes up. So what happens is they say, okay, this 4% is tied to that, so if interest rates go up, this will go up, and so if that goes to 5%, well, then that will be passed on to you, and this will be 2,500, or you'll get a better return. The cap rates will go up. You'll have more potential. That's not true. It's not the way it works. What happens is 4% goes to an options budget. The options budget then is determined. They take the $2,000, they put it into the options budget. So if it comes through, if the option wins, it's a call option. If the call option wins, let's say you have a 10% cap. So anything 0 to 10%, you would get that. If it's over 10%, you would get 8%. If it was over 10%, you'd get the 10%. If it was anywhere between 0 and 10, you'd get that number, assuming it's 100% participation rate. That's what we're assuming. Now, what happens here? This is what's nuts. If it doesn't come in, let's say we have a negative year. How do they give you the upside potential but downside protection? Is because they're taking this general fund. They know that their account with your $50,000 deposit, they know that account is going to get you 4%. So they're risking the guaranteed gain inside of an option. And if it comes in, you get the gain. And if it doesn't, you get that. Now, what causes the cap? I said 0. I'm going to just do this. I said 0 to 10%. This is the cap. Okay. What causes this cap? Well, we have the fixed market here, right? What is the general fund getting? So yes, they're right. This could go up to 5%. What happens in an increasing interest rate environment? We usually have more volatility in the market, right? What happens in more volatility? Typically options get pricey, right? So if that happens, what also, if this goes up, but the options budget goes to buy options to get a return, well, if the options costs go up here, the options budget is going to buy less. So even if you have a $2,500 budget, if the cost of options goes up, it doesn't necessarily mean you're going to actually buy more. In fact, there's been a lot of talk by industry experts saying that even in this increasing environment, they still expect cap rates to continue to drop. And so this is really, really, really important to understand all these moving parts. And this is why this right here has really, like, it's just manipulative. So what are the requirements? The commitment, let's see here, the commitment to make a partial annual premium payments, complete a life insurance application, which may include a medical underwriting, and sign all the necessary trust forms. Okay, fair enough. I showed you this. This is just, I mean, to me, this is ridiculous. So what they're doing is they're saying, hey, take 135K, or no, take 150K. I'm going to erase that so it doesn't look bad. My OCD is getting there. Take 150K of your own money and leverage it out for $35,000 a year of income from the time you are 71 until the time you are 90. And so that's basically 20 years of income. But once again, this is all speculative. There are plenty of things in this world if the policy doesn't perform. So right here you can see this is assuming a 6.03 assumption on the policy growth, right? So if the policy goes at that 4.5%, even to 5%, this is going to be lower. These numbers, this retirement income is going to be lower than you expect. The policy is going to not do well. The leverage that you utilize to get these bank loans here, that leverage is going to come back to bite you, because now, whereas you were supposed to start getting income in year 15, well, guess what? Maybe it takes an extra year or two to pay these policy loans back, so you don't get this there. And maybe when you get there, the money isn't worth as much. And the bottom line is $35,000 15 years from now really is only going to be worth, with inflation, about 20 to 22K in today's dollars. So you're really risking 150K of your own hard-earned money to take a lot of speculation, a lot of risk, at the chance of having $20,000 to $22,000 a year of income, in today's purchasing power. To me, that just doesn't make any sense when we look at this. Now, the plan proposal loan rate. So this is where it gets really fun. Here's the fine print, and this is fascinating. So loan terms are dependent on the lender and are not guaranteed for the full term of the plan. This is simply saying that you're using your own money for the first 5 years, and there's no guarantee that the lender is required to give you the money to pay for your premiums every single year. So that is a risk. Your credit is a risk. Your employability, your cash flow to cover it is a risk. There's no guarantee that they're going to cover that for you for every year of the plan, yet they're selling it. I mean, that is a massive, massive risk. If we hit a financial crisis, which I don't know about you, but I think we're coming into one, we don't know what the credit markets are going to do. And at any point in time, they can dry up. And I think these are doomed to cause a lot of problem potentially for a lot of people. Financing life insurance premiums has certain inherent risks, including interest rate fluctuations, financial markets performance. That's the other thing I didn't talk about, interest rate fluctuation. Think about that. If we go through here, these interest rates for your bank loan are not guaranteed, right? The interest rates that you're paying, so the interest that's due on this bank loan, is not guaranteed. It can go up. If that goes up, this will hurt over here as well. So there's so many moving parts you need to understand about this. If you don't have like the financial intellect to navigate every moving part of this, you should just avoid this like the plague. Credit availability, once again, the bank lender financial strength. What if the bank actually goes out of business and can't do it? 569 banks failed in 2008 and 9. Lender funds availability. Maybe they just want to dry up and they don't want to, they lock up their credit availability. Insurance company ratings and stability, which can result in the bank loan exiting and or the policy surrender. Like, these are all things that are going to cause a lot of problems. The client will not have access to the policy, the cash values, to the death benefit or the living benefits until the loan is repaid and the assignment is released. Underperformance could result in a lower death benefit, cash surrender value, and lower annual income. Results may be less favorable. NIW nor any of its affiliates represent the lenders or the insurance carriers. So ultimately, what you're seeing here is the fact that this idea of ultimately premium financing, and what is to me completely atrocious to this, is that you're taking a 55-year-old here, you know, $900,000 of death benefit. You're putting a normal rank and file type employee that's earning maybe $100,000 to $150,000 a year. You're putting them into a financial vehicle that is hyper speculative, that's taking on a lot of risk, and ultimately could wind up completely annihilating and eviscerating their ability to retire with the standard of living that they're going for. So this is why you need to read the fine print in all these things, whether it's this program, this is just a marketing program. Once again, I don't know the IUL company that these guys are using, but it's certainly an IUL. It's effectively taking a high-level premium finance strategy that you need to be an accredited investor for, and they're trying to bring it to the masses. It's dangerous. Avoid it. If you have any questions, comment in the comment section below. And if you haven't already, make sure you subscribe, hit the bell, that way you get notified every time I release a new video. I'm doing my best to do all sorts of reviews on illustrations, marketing programs, all these different things to bring education to people so they understand the difference in the different nuances of all these different programs that you need to understand so you can make an educated decision in what's best for you. If you have any questions, reach out. Have a blessed, inspirational day. We'll see you on the next video. Take care.